KAL Group has reported a 4.6% decline in first half headline earnings, but the agriculture, fuel and manufacturing company expects a significantly improved performance in its second half. Revenue came under pressure during the first half. KAL Group CEO Sean Walsh has further insight on that performance. Thank you so much for your time, Sean. Let's actually start off there with the revenue. Just paint a picture of that top line during this period and really the dynamics at play here and the impact of the contributions of the different divisions.
Zanati, thank you. So the listeners must remember that we do about 50 million litres of fuel every month. So the 3 to 4 rand a litre, that the price is lower, will obviously affect our revenue in that it's now down at a lower fuel price per litre. But that does not affect the profitability in any way, and you would have seen that if you look deeper, the gross profits actually grew by 1% in the same period.
And actually with that, I mean, in your fuel operations, how much room is there for market share gains? Because I saw that there was an outperformance of the general industry as much as the sales volumes actually softened.
Yes, so Zanati, so what we've been doing is a concerted effort to grow in areas which we have been underrepresented in the past, like the Eastern Cape. We are growing with fertilizers and other agricultural inputs. We are driving that by focusing on top 200 customers in the areas. We are growing with agri inputs on netting infrastructure as well as fertilizers as well. So just because the economy is showing sluggish growth doesn't mean that you can't go and grow market share in South Africa, and we are intent on doing that.
Well, you talk about the economy showing sluggish growth, and I'm interested in what kind of consumer demand trends you've been seeing impacting your business, those driving tailwinds and headwinds.
So the drags on the business have collectively been the building material categories, your sand, your cement, your paint, your hardware. Those building materials categories have seen very low growth, if not minus 3% in our case, and cement volumes down 0.7%. Fortunately, other categories like hunting, liquor, general retail, pet and accessories have seen a bit of growth, but the standout performance has been our convenience retail, and that is really linked to an improved and expanded offering of retail at our fuel retail service stations, and expanding quick service restaurants, adding additional service offerings at certain sites. So we have seen about a 7.8% uptick in our retail spend per litre at our fuel stations.
All right. And just with your agriculture-focused businesses, how did those perform? And I'm asking this leading on to the second half of that question, which is the potential anticipated impact of US tariffs.
So the tariffs are a massive elephant in the room at the moment. The Bureau for Food and Agricultural Policy has determined that by volume, the total exports to the US are only 3% of agricultural exports in South Africa. So when one looks at it holistically, it should not have a large impact on not only us, but on the South African agricultural sector. But where it will definitely have an impact is on a micro sector basis. You'll look at citrus for the Western Cape, not necessarily the rest of the country, where the impact will be larger because the value of citrus exports out of the Western Cape to the US is much higher. So we are watching all of that. Our estimations that we have a risk of between 2 and 3% of EBITDA in the second half of this year. That is quite low still at this stage, and that is based on nothing being done whatsoever from a negotiation point of view.
Yes.
We must all understand that at the moment the government is engaging with US representatives, and we hope that an impasse can be made in terms of reciprocal tariffs with and at least putting us on an equivalent foot to Chile and Peru. Having said that, if that all plays out, Sonati, we are actually expecting a much better second half of this financial year for ourselves, and especially in our Agrimark division. Our quarter four last year of our financial year ending September, we were minus 32%. In the first quarter of this financial year, we were plus 2%.
Yeah.
And in the second quarter of this year, we were plus 12%. So that upward trajectory is really boding well for our next two quarters.
All right. I did hear you mentioning expansion. What does your expansion drive look like, and where are you focusing that on, Sean?
So, Nati, that is a mixture of, from a service station point of view, acquiring additional sites. In South Africa, we're currently operating 80 sites. We would like to add in the region of 30 to 35 sites over the next 5 years. We have 5 in this that we should be onboarding in the second half of this year. We have 3 new QSRs which we should onboard in the second half. We have an additional pipeline of up to 7 service stations for the next 18 months, and about 10 revamps and upgrades of QSRs in next year. Added to that, we are intent on also growing market share quite aggressively from the agricultural input side, which will mainly happen in the Agrimark business segment. And then never fear how important it is for operational efficiencies. This year, our operational expenditure in the first half has only grown by 1.9%. That's an amazing feat for us. And at the same time, Sonati, it's always easier to grow when you are growing off a healthy base. We've reduced debt by 244 million this half. Our debt to equity is the lowest in 10 years.
Wow.
So we are really ready to utilize our healthy balance sheet to grow and return value to shareholders.
Okay, it's quite interesting that you talk about that significant debt reduction, but also then amid this expansion, how much room then do you still have for more debt reduction, or are you just at a comfortable place now where you don't actually need to be aggressive with that at this stage?
Yes, so Nati, our outlook is that we'll probably take that debt to equity of 48% down to around 42, 43, low 40s this year. It'll start then ticking up a bit. So depending on the pace of the service station expansion, and depending as well mainly on our credit sales growth, we would be able to tick that up to probably again 50, 55, but the objective is always to bring it back down to that 40 level.
Yeah, all right. Well, thank you so much for your time and for giving us more detail on those numbers, and really quite encouraging to see a tone of optimism for the second half of the financial year. That was Sean Walsh, CEO of KAL Group.